New mortgage rules to cool the property market. Let's have a look. Hello everyone, Florian.Heise here and welcome to another episode of HeiseSays. Grab your stein of coffee. I want to have a talk about this article from Yahoo Finance discussing the new mortgage rules coming out from APRA. Now this is to do with the banks. When they're assessing your ability to get a mortgage, they need to buffer in an interest rate increase. Now, it looks like the RBA has given up on yield curve controls. I may have to reluctantly update this chart. It means I have to download a picture, copy it to a directory, and link it to my software. Just, the RBA is just being so selfish. They need to think about us amateur YouTubers. So anyway, this is from Yahoo Finance. So, Australians hoping to buy property will be forced to prove they can repay their mortgage if rates rise 3% under new rules coming into place on Monday, the 1st of November. Okay, so there you go. This is why when everyone is going on about rates going up huge amounts and everyone's going to topple over and the market will collapse, I just don't believe it anymore. They've got so many buffers in place. What it will do is, if rates go up, sure, there'll be some people forced to sell. There will be some people that will be forced to sell. We will probably see a recession if it's a big enough increase because people's spending habits will change. People will stop going around wasting money on things that, keeps the economy going. The Australian Prudential Regulation Authority announced the high stress test earlier in October, increasing the test from 2.5% to 3%. That means banks will need to check whether borrowers can manage repayments if interest rates increase by 3%, or they can meet the bank's own serviceability floor if that is higher. And here's the big fact, their serviceability floor. So, there you go. There you go, guys. That's what the CBA expects you to be able to pay, 5.25%. According to APRA, the restrictions will reduce borrowers' maximum borrowing capacity by around 5%. So that's the impact it will have on the property sector. It'll cool it a little bit, everyone. But here's the thing. They've built these buffers into it. What people don't want in Australia, and probably most parts of the world, they don't want the exciting free market. Majority of them don't. Sure, they love it when it's all going good, but they want constraints, they want order, they want it to be, they want to go bowling with bumpers. And that's what we have here. For a family of four with an annual household income of $150,000, their maximum borrowing power would fall by an estimated $46,900, according to RateCity.com.au analysts. For a single borrower earning $100,000, their maximum borrowing capacity would fall by around $34,900, and we can see here the differences. And just imagine if you're a family of six, everyone. Remember, having kids, that impacts your ability to borrow money. So that's another thing. People don't want to get a kid until they get a house for some reason because it limits how much you can borrow too. Because the banks seem to think kids cost a lot of money. When you dollar cost average them, they get cheaper. I'm speaking from experience. So here's the impact on a single person, guys. There you go, down 80 grand for earning 250 grand. Oh no, they can only borrow 1.5 million. So they can only get into an average house. A median house in Sydney. Damn. Borrowers waiting for their mortgage to settle will still be processed under the 2.5% rule. The same goes for those with pre-approval. However, they will need to buy and make a full loan application within 90 days for some lenders. While the big banks have said they'll honour pre-approvals if your circumstances have changed, you might have to start from scratch under the new rules, Rate City Research Director Sally Tyndall said. The last thing you want your new home loan to do is to fall short. And she added people looking to bid at an auction should check with their bank on how much they can borrow. So, while buyers who aren't borrowing at or near capacity are unlikely to be deterred, this new change could be the last straw for some first home buyers trying to stretch themselves to get into the market, Tyndall said. Well, then, okay, if you're that close to get into the market, guys, that's a problem. That means you're like Icarus, you're flying too close to the sun, you're going to get burned. And this is why they have these rules in place. It's destroying opportunities. This is making it harder for people to get into property as well. But it's also trying to limit the risk of people falling and then collapsing and, forced sales. And they want to manage it. Is it better for Is all this intervention in the market better in the long run or worse in the long run? Well, look at housing affordability. Although the new higher mortgage stress test may seem frustrating for some people, this move is designed to protect borrowers when rates will undoubtedly rise. APRA considers loans with a debt-to-income ratio of 6 or higher to be risky, and already 21.9% of new loans hit this benchmark in the June 2021 quarter. So here we go, how the Big Four banks are managing existing home loan applications. And I'll let you go through that in the article. CoreLogic is due to reveal how much home values have grown across Australia on Monday, the 1st of November, amid anticipation that the Reserve Bank will increase interest rates sooner than expected. If debt-to-income levels keep rising, we'll likely see APRA intervene with additional restrictions before the year is out, Tyndall said. So, I mean, there we go, everyone. There we go. This is the thing. This is the issue. We're seeing APRA intervene in the market, restricting or putting in safety buffers for the bank, and that means you've got people that have, and on top of that, you also have people that have prepaid their mortgages. So the bank also takes account of them having to be able to handle higher rates. You've got people who've prepaid their mortgages. You've got people who have got liquidity buffers. But then don't forget, we also have, hang on, wait a minute. We've got a precedent now of loan deferrals. So none of these billions of dollars worth of mortgages where the banks gave them deferrals, none of them were considered in default. APRA let the banks put them in another little box so that they manage them differently. That's another thing to consider. I mean, could that come back? I make the joke constantly of Mortgage Keeper, joking around that could happen. We've got an election coming up. Can you see it happening? Would you be surprised or shocked if the government intervened in the market like that? So generally, I mean, guys, what we're seeing here is, the APRA is forcing the banks to have increased serviceability floors or buffers, interest rate buffers that their borrowers need to have. It may cool the market a little bit. It may squeeze some people out of the market who may not have probably shouldn't have been going into the market, but I can't see it having a drastic. You're not going to get the huge crash that some people are salivating for, waiting for. Now, I want you to watch this other video here. This is discussing home loan delinquencies increasing. Now, sure, they've increased, but not by enough for people to notice, guys. Not by that much, everyone. Keep an eye on this space. Let's see how it's all going. Thanks for watching, guys, and I will see you all in the next episode. Take care. That's a good Steiner coffee, everyone.